Good morning from sunny and hot Chicago, home of the first place Chicago White Sox. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thank you for watching our latest Following the Money bi-weekly podcast. Today is Sunday, July 12th, 2026. Since our previous Follow the Money exactly 2 weeks ago, the U.S. economy has remained resilient with a still healthy labor market and steady economic growth, helping offset persistent inflationary pressures. While job growth has cooled, unemployment has remained low, near 4.2%, reinforcing expectations for continued economic expansion without signaling an imminent recession. At the same time, elevated inflation, higher energy prices, and ongoing tariff-related cost pressures have kept investors uncertain about the Federal Reserve's next move, which has pushed Treasury yields higher. We've got long Treasury yields in the 10 and the 30-year bond up at levels, in some cases, in the case of the 30-year, that's been an upside barrier for those yields going back 15 years or more. Economically, the current market backdrop continues to reflect an economy that is expanding rather than contracting, as investors remain willing to favor economically sensitive assets, despite a period of recent market indecision that we've been seeing here really since the beginning of June. Leadership by semiconductors, large cap tech, small caps, and growth stocks remain broadly consistent with expectations for improving corporate earnings, healthy liquidity, and continued confidence in future economic growth. Although each of these leadership groups has now reached an important strategic inflection point. We're going to be looking at some charts that show you what I'm talking about here. How these inflection points are going to be resolved here over the next week or two are going to help determine whether this expansion broadens or begins to lose momentum. Supporting the constructive outlook, stocks have resumed outperforming long-term Treasury bonds, while our Asbury 6 market internals model continues to confirm broad participation beneath the market surface, indicating that institutional investors remain positioned for more upside. For some additional upside, specifically in the S&P 500. At the same time, the recent relative strength of the traditionally defensive Dow 30 serves as an important caution flag, suggesting that some investors are beginning to position themselves more conservatively, even as the major averages remain near record highs. This combination points to an economy that is still fundamentally healthy, but entering a more mature phase of the current expansion, where continued market gains will increasingly depend on cyclical leadership reasserting itself rather than broad multiple expansion alone. Until those leadership trends break decisively, which we're going to find out here in the next week or two, the weight of the evidence still favors ongoing economic expansion and a bullish intermediate-term outlook for U.S. equities. Now, we're going to get into more detail by looking at some of the key forces that are driving the market today, including some of our most important charts, some relevant data series, and our own quantitative rules-based models. Before we do, let me just take a minute or two to tell you a little bit about Asbury Research and what we do. Asbury Research is an RIA. We're a registered investment advisor. I launched Asbury Research in 2005 after spending 25 years in the financial business, most of it on the trading floor of the Chicago Mercantile Exchange in the 1980s and 1990s, where there was still open outcry back then. This is where I learned how the markets work from the inside out, and it's really been the launching pad for my career. Asbury has been providing investment research to both individual investors and professional money managers since 2005, utilizing what we call intelligent diversification. Intelligent diversification is an actively managed approach that we created to constantly adapt to changing market conditions rather than relying on the traditional static set it and forget it allocation models. The 60-40 stock and bond portfolio, which are popular with most advisors, is probably the poster boy for that. We don't believe in that approach. We think that the market should be telling us how to invest and not a meeting that we had 3 years ago with a guy in a suit. There are two ways to access Asbury Research. Number one, by subscribing to a research product or products. We actually have two, or investing in our managed portfolios. For those interested in research, Asbury offers both its flagship Asbury Premium Research Service that we launched in '05, and more recently, we launched the low-cost entry-level Substack newsletter. We'll take a closer look at the Substack at the end of the presentation today. It's kind of an entry-level way to get more Asbury Research to follow our approach a little bit more closely. For those who prefer a managed account, we have created 5 model portfolios using our own correction protection model, our CPM model, and our CEF model as building blocks. These model portfolios have undergone extensive back testing and have been trading in real time for 2 years. Year to date, let's take a look at what we're talking about here visually. It's a little bit easier to understand if we can take a look at it closer. And so what we have here, this is the back-tested view since the middle of 2018. So this is 8 years on how our model portfolios compare to standard benchmarks. This purple line down at the bottom, this is AOR, ticker AOR. It is an ETF that emulates a 60-40 stock and bond portfolio. That's purple down at the bottom. This orange line here, just above it, that is the S&P 500. And again, it goes back from the middle of 2018 through last week. So you've got 8 years of data. Our green line that's the Asbury Balanced Model portfolio. That one is in the middle of the spectrum. We have 5 different model portfolios, so this one is kind of equally balanced between offense and defense, and you can see how that has done. It's outperformed the S&P. This is the ultra aggressive model up here in blue up at the top, as the name suggests. It's aggressive. It uses some leverage, but it's very significantly outperformed, and it's really pulled away since about the first third of 2025, as you can see right down here. So year to date, 3 of our model portfolios are outperforming the S&P to various degrees and have smaller drawdowns than the S&P 500. Our Asbury Balance, which we're looking at there in green, our Asbury Conservative and our Asbury Ultra Conservative model portfolios, year to date drawdowns have been less than that of the S&P 500. Full disclosure, all of my own money that's invested in stocks, invested in equities, are all invested in our own models. So, we're eating our own cooking here. All right, now let's get down to the reason you're here and look at some charts data and some of our own models. So we're going to begin by going back to the website, and we're going to go inside the Research Center. That is the paywall for those who have a premium research subscription. And the first thing we're going to look at is we're going to see what the Asbury 6 is doing. Most people that know me and know Asbury Research are probably familiar with the Asbury 6. So this is the Asbury 6 through the end of last week. What is the Asbury 6? It's a daily data-driven gauge of the U.S. stock market's real internal health according to 6 diverse metrics that were selected via quantitative backtesting. It quantitatively answers the question, should I be increasing or decreasing my exposure to the stock market? Think of it as kind of, the way we think of it here, as kind of an EKG, a daily EKG of the market. It's meant to be an indicator rather than a model. Again, it's a daily indication of the broad market's internal health. It looks at 6 metrics that we group together because they cover the weak spots of the others. The sum are greater than the parts. We're looking at the rate of change in the S&P 500, relative performance of stocks and high yield bonds, investor asset flows, volatility, follow my mouse, trading volume, and market breadth. 4 or more in any direction, it indicates a directional signal. So 4 or more green, these are the dates that each of these actually turn to positive. 4 or more indicates a positive bias for the model. 4 or more green, I should say. 4 or more red indicates a negative bias for the model. Positive as of the close July 1st. So heading into this week, 5 of 6 are positive. The only one that is negative is trading volume. So The A6 has underperformed the S&P slightly by about 2% annualized since 2017, but its maximum drawdown is only 11.5%, less than a third of the S&P 500's drawdown, its maximum drawdown, which was 33.9%, and that was during COVID. Trades about 9 times a year. It's active, so it in and outs 9 times. So from green to red, that is one round turn. So it's active. It's a part of our premium research subscription. But I've talked to a lot of older investors. I'm an older investor, that if they could underperform the S&P 500 by 2% a year and only have 11.5% drawdown instead of a 34% drawdown, they do that deal all day long. So if that's you, this might be something that is useful for your own investing. Next thing we're going to look at is another one of our kind of cornerstone models. It's the SEAF model. SEAF is an acronym. It stands for Sector ETF Asset Flows. And here's a graphic. So this is updated every week. Unlike the A6, which is updated every day after the close, this is updated once a week. And what it is a completely data-driven sector rotation model created to quantitatively identify long or overweight opportunities in U.S. market sectors by following the money. That's our motto here, following the money as it moves around the 11 sector spiders, which together, if you put these 11 together, it's the S&P 500, basically sliced into 11 different sized slices. SEAF model is always fully invested in the market, providing investors with a dynamic market-generated alternative to the traditional buy and hold, set it and forget it portion of your portfolio. A lot of our users, either those that are using the model portfolios or those that are buying the research, this is the part that they keep in the market all the time. And again, it replaces that 60-40 kind of set it and forget it portfolio that doesn't work anymore. Year to date, SEAF is trailing the S&P 500 by 0.7%, but with a 38% lower maximum drawdown, an 8% lower standard deviation, and a 56% higher Sharpe ratio. Sharpe ratio is a little wonky. It's kind of the standard for risk-adjusted returns. The higher the Sharpe ratio, the more bang for your buck you're getting, so to speak. You're getting a better return for how much you're risking. Since inception, which is the middle of 2018, SEAF has outperformed by 6.8% on an annualized basis, so 6.8% a year on an annualized basis, with a 13% lower maximum drawdown, a 27% lower standard deviation, which measures volatility within your account, and a 51% higher Sharpe ratio. The current signals are technology, financials, and materials. So what does that mean? We have back-tested this to the nth degree to try to determine where the value is, how to squeeze the most juice out of this. And what we found is that always trading or always participating in the top 3. So the top 3 heading into next week are XLK, technology, XLF, financials, and XLB, materials. So on a hypothetical $100,000 account, we would be 33.3% or $33,300 invested in all 3 equally across the board. If next week that money moves around and let's say materials drop out of the top 3 and real estate moves up into the top 3, what we'll do is that following Monday on the open, we'll sell out our XLB and we'll buy XLRE. Now we're equally balanced, and now we just leave it for the rest of the week. What does all this mean? We've built an algorithm that measures the velocity of money that moves around the 11 sector spiders. And then we rank them in 3 different time periods: trading week, tactical month, and strategic quarter. So you can see last week, the fastest money that was moving in on a trading basis was in technology, XLK. The fastest money that was moving out over the past week was healthcare. So money moved out of healthcare and industrials here, and it moved into technology and also energy. Okay, so we have a score for each of those, and we have a tactical score and we have a strategic score. We add those up together, and you can see technology and financials both have a composite ranking of 11. So those are the two strongest. Those are the ones that we invest in. The other thing I wanted to show you, so you maybe get a better understanding of what we're doing, is we've created our own charts to display the CEF model. And we call them rainbow charts, and you're going to see why in about a minute. What we did here is let's go to financials. So up at the top, what we have is the day-to-day ranking score for the financial sector going back 1 year. This is 1 year. You can see why we call it a rainbow chart. Favored is green, neutral is yellow, avoid is red. This underneath is the relative performance of XLF financials versus the S&P 500 SPY. So you can see here, just eyeballing this, looks like June 20th-ish is when the financials moved into favored CEF ranking. Look what's happened. We've got outperformance here. Look what's happened here. Earlier, this was October through the end of the year. So this is basically the fourth quarter of last year where financials got down into a void, and it stayed there with very few exceptions. Look what happened. We had relative underperformance by XLF. Let's look at one more quickly. Energy. Energy went into favored territory back in January. Midway through January, it stayed there through early April. Look at all this relative outperformance that went with it as XLE outperformed SPY. Once we dropped out of there, look what happened. I mean, we had a little run here back into favored in late May, which gave us a little pop here, but otherwise, we caught this entire move and then we got out of the way and missed all of this. So this is the importance of these charts, and this is why we pay so much attention to them. Next thing we're going to do is we're going to look at one of our regular reports that comes out every week. It's called Keys to This Week. So we're scrolling down through the Research Center, and here's Keys to This Week. I'm not going to show you all the charts in the report, but we're going to go through a few that will hopefully give you a nice visual as to what we talked about in the very beginning when we're just kind of rattling off what we're looking at and why. This will hopefully put some pictures to this. So number one, this is just the S&P 500. This goes back to the beginning of the year. And I said that we've been drifting sideways since June. This sideways drift is actually a chart pattern. We don't like to use jargon. It's called a symmetrical triangle. But what it means is that after coiling, because the market had a hell of a run here, and then it took a rest. So it's starting to break out to the upside. As long as we stay up above the upper part of this pattern at 74.90 and the 50-day moving average, which is a widely watched minor trend proxy at 74.24, this will give us a target, another 4% rise to 78.50. So that's what we're focusing on now. Here's our risk, and 78.50 is what we're looking for on the upside. This is chart 2. This is the SOX index. It's the Philex Semiconductor Index. And down here is the SOX relative performance versus the S&P 500 down here. This starts off in April of last year. What we see here in May of 2025, SOX started outperforming SPY. SOX is typically kind of a high beta asset. When the market's doing well, when investors are enthused and they're looking to take risks, SOX is one of the places they go. Look at this. It has stayed above its 63-day moving average. Why 63 days? That's a business quarter, and that's our strategic time period. It's stayed above this all this time. We just did it on September 2nd. That was the bottom in SOX. Again, in November and December, 2 bottoms in the SOX. Tested again in early and late March, right here, 2 more bottoms. And look where we are now. We bounced it off a test of it on July the 7th, about a week ago, a few days ago, really. And now it's got another decision to make. As long as the SOX keeps outperforming, we should see another leg higher in the S&P 500 as indicated by that first chart that I showed you. If this fails, we've lost an important part of the leadership of the market. Next, this is the NASDAQ 100. This is the 100 largest technology stocks. Note that NDX started outperforming SPY here in the bottom on April the 8th, and it's testing that 63-day moving. So on April 8th, we began a quarterly trend of relative outperformance by NDX versus SPY. That's getting tested. If this holds and we continue outperforming in NDX, we're going to get another leg higher in the S&P 500. If this fails, again, we've lost another piece of very imperative leadership that the market needs, the broad market, the S&P 500 needs to keep the uptrend alive. Next, this is small cap. Small cap's been a little bit erratic, but it's generally been also outperforming the S&P 500 since the latter part of last year. Since May 22nd, IWM, which is the ETF that tracks the Russell 2000, started outperforming SPY. It's quasi-testing its 63-day trend here now. So again, the leaders in the market, semis, big cap tech, small cap, they're all testing their quarterly trends of outperformance versus the S&P 500. This is the fly in the ointment, so to speak. This is DIA. DIA is the Dow 30. When the Dow is underperforming, it's because the market thinks there's better opportunities elsewhere. It'll be in technology. It'll be in semis. When the Dow starts outperforming, as this has been doing on a quarterly 63-day basis since June the 16th, this means that some managers out there are having doubts about whether the S&P 500 could keep up its uptrend that it's had for most of this year. And when professional money managers don't like the market, they can't stop trading for 3 months and go fishing. They need to invest that money. Most managers have a mandate. They have to be at least 80% invested. This is a place that they go when they're afraid the market has gotten a little too far out over its skis. That's what a portion of the market thinks right now. So there's already a cautious part of the market out there, and 3 of our leaders are testing their quarterly trends of relative outperformance versus the S&P 500. So this is what we're focusing on, and think frankly you should too. Last chart. This is a seasonality chart in the S&P 500. To me, it's tertiary. I'm never going to make a trade, and I never have made a trade based on seasonality, but I like to see how the seasonal pattern overlays with what's happening now. So what we see is, generally speaking, from May through September, we've got seasonal weakness in the stock market. No, it doesn't happen every year, but generally speaking, with a pretty good look back here, about a 75-year look back, 70-year look back, that's the pattern. But July is typically strong. So you have a weaker May, a weaker June, you have a little rebound in July, and then August, September are usually pretty lousy months. So seasonality would suggest we may get a rally. But again, it all keys on paying special attention to those relative performance relationships. Next thing we're going to do here is we're going to go to the Substack. I told you that we'd spend a few minutes on the Substack. Our premium research is expensive. It's $500 a quarter. That's a big bite for a lot of people, and we know that. So we came up with a Substack, which is $25 a month, and it has a lot of the components. It doesn't have the models, but it has a lot of components of the research, and it's a great kind of gateway drug, so to speak, into either moving into one of our managed account portfolios or into the premium research. There's three parts of this. Our chart focus is the first one. And chart focus looks a lot like Keys to This Week. Not going to go through the whole thing, but it's a lot of dialogue, it's a lot of summary, and then a lot of pictures, a lot of different charts. This is once a week. The second thing is our sort report. Our sort report is exclusive to our Substack, and what we do with sort is we take all these different assets, small cap, the dollar, crude oil, technology, emerging markets, crypto, global equities, U.S. interest rates, commodities, and gold, and we measure them by positive trend, relative performance versus whatever their benchmark is. A lot of these are the S&P 500, and then asset flows. Is there new money going in these assets to push them higher? Right now, there's only one that is checking all the boxes, so to speak, and it's small cap. Trend, relative performance, and money flows are all green. So what this is for is if you're a casual investor or not somebody that's following the markets every minute of every day, and you want to get a quick and dirty look at what's working and what's not. What's working right now is small cap. What's not working right now is gold. This gives you a very good back of the envelope place to start when you're looking for individual ETFs or individual stocks to buy. The third part of this is relatively new, but it's a rainbow chart report. We don't give you all of the 11, but we give you 3. It's kind of an entry level to Asbury Research. So here we're looking at financials, we're looking at utilities, and we're looking at energy. So those are the 3 pieces of the Substack. That's it. This wraps up today's latest Asbury Research Found the Money podcast. The next one tentatively scheduled 3 weeks from today on Sunday, August 2nd. Hope to see you then. Just a couple of media notes. We're going to be doing a lot of media stuff here over the next couple of weeks. I know some people like to follow us in the media. On Tuesday, July the 15th, which is coming up, I'll be interviewed on the Schwab Network at about 9:10 a.m. Chicago time. And same day, that evening, my son Jack and I are going to be presenting our work to the Canada Technical Analysis Society. I had to read out the whole name. It's Canada Technical Analysis Society, and this will be at 7 p.m. That's a private event if you have access to it, but that's going to be later that day. On Wednesday, July the 29th, it's going to be our mid-year outlook for Fidelity Investments. We've been doing this for 11 years for Fidelity. This is our 11th year. If you go, I think it's fidelityevents.com. It's free. You could sign up for free. It's an hour long, and it's going to go through all of our latest research. And then finally, on Thursday, July 30th, CNBC Arabia is going to be interviewing me at 8:40 in the morning. So if you speak Arabic and you're available, you can find me there. One last thing before we go is our focus on this YouTube channel is to give you a realistic, data-driven, no BS, practical look at the financial markets and investing from a guy that's been doing this for most of his life. There's a lot of show business out there in the financial world. Just turn on CNBC. A lot of show business out there, a lot of Rolexes, a lot of nice suits, and a lot of hype. And some of the claims, don't believe everything that you hear or everything that you read. A lot of junk to sift through to try to find what works for you. That's why we've built our own metrics and models to pay attention to what we think is real and relevant rather than focusing on the canned indicators that you can get for free on the internet, the MACDs and the stochastics, or the classic chart patterns that were really cutting edge in the 1960s, and I used them for a long time, but have now oftentimes become traps for investors where you'll break out of a chart pattern and the next 3 days will be right in your face. So we've really moved to quantitatively looking at markets. Everything we do is based on data. If we have an idea, we quantitatively backtest it for 5 to 8 years before we even consider to integrate it into what we produce for our subscribers and integrating them into our model portfolios. And our backtests are focused on defense first. It's really important to us. How big the drawdowns are versus the S&P 500, how volatile your account is versus the S&P 500, and what the risk-adjusted returns look like. Many trading strategies are sold to Wall Street on one spectacular year, maybe a 50% crazy year, 50, 60% year outperformance. It attracts a lot of capital and keeps capital there for a while. But our approach is to keep you in the game as the stock market inherently goes up over time, and to try to let you sleep at night and to take the volatility out of the market. Our CPM model has been right on top of the S&P for 8 years, but the drawdown is 40% less and the risk-adjusted returns are much better. If you have any questions or want more information on our research subscriptions or our managed account services, you can contact us by the contact tab right here at asburyresearch.com. I'll see you again in 2 weeks. Thanks for joining me today. Go White Sox. Enjoy your Sunday. And don't forget to like and subscribe.